Something just broke across global markets, and most people still have not connected the dots. War risk is rising, oil just spiked, silver is swinging violently, and while traders are staring at the chaos, gold may have already delivered the single biggest warning signal of the entire move. This is not just another noisy headline cycle. This is the kind of moment that can reset pricing across commodities, currencies, bonds, and risk assets all at once. And if you only look at silver's volatility without understanding what gold is saying right now, you could miss the real story completely. What happened is simple on the surface, but dangerous underneath. A fresh war shock hit the market narrative. Oil reacted immediately because energy is always the first pressure point when geopolitical risk starts expanding. Silver turned chaotic because it sits in the uncomfortable middle ground between industrial metal and monetary metal. And gold, instead of hesitating, started behaving like capital was looking for protection before the broader market fully admitted what was happening. That matters because gold usually moves with purpose when fear is still being debated by everyone else. And this is where the story gets more serious. Most people think war headlines create a quick spike, traders overreact, and then the market calms down. Sometimes that is true, but not when the move starts spreading from headlines into supply chains, inflation expectations, bond behavior, currency stress, and central bank psychology. That is when a scary headline stops being a headline and starts becoming a macro event. And if this is becoming a macro event, then silver's chaos is not random at all. It is the market struggling to price two conflicting futures at the same time. On one side, silver should benefit if investors start running toward hard assets, distrust paper promises, and prepare for more inflation. On the other side, silver gets hit when panic makes traders dump anything volatile, especially if they fear slower growth, tighter liquidity, or broad liquidation across risk markets. That is why silver looks so messy in moments like this. It is being pulled by fear, inflation, industrial demand, monetary demand, and leverage all at once. And when too many forces collide in one asset, price action stops looking clean. It starts looking violent. But gold is different. Gold does not have to negotiate with industrial demand the same way silver does. Gold does not need the market to decide whether this is a growth scare or an inflation scare before it makes up its mind. Gold reacts to trust. Trust in currencies, trust in central banks, trust in governments, trust in the stability of the system itself. So when gold sends a strong signal during a war shock, while silver is still whipping around, that often means the smart money is not just trading a headline, it is preparing for a deeper repricing of uncertainty. That is the first thing most people are missing. The second thing they are missing is oil. Oil is not just another commodity on the board. Oil is upstream inflation. It touches transport, manufacturing, shipping, agriculture, logistics, plastics, chemicals, and ultimately, consumer prices. When oil jumps on war risk, the market has to start asking a very uncomfortable question. What happens if inflation pressure returns before central banks have fully regained control? That is the nightmare setup, because it traps policymakers between two bad choices: fight inflation harder and risk breaking growth, or tolerate inflation and risk destroying purchasing power even faster. Now think about what that does to metals. Gold loves that kind of confusion because policy confusion weakens confidence in real yields, in currency stability, and in the credibility of the people steering the economy. Silver can love it too, but silver rarely gets a smooth ride there. It tends to overshoot, reverse, shake out weak hands, then move again. It is the more emotional cousin in the precious metals family. Gold whispers first. Silver often screams later. And if gold has already started whispering that something is wrong, silver's chaos may not be a reason to run away. It may be the setup before a much bigger directional move. But there is a hidden risk inside this story that almost nobody is talking about carefully enough. What if the market is not facing one shock, but three at the same time? Shock number one is geopolitical escalation. That is obvious. Shock number two is energy repricing through oil. That is already happening. Shock number three is the possibility that capital rotates out of confidence-sensitive assets into hard assets faster than expected. If those three shocks begin reinforcing each other, then this stops being a temporary war trade and starts becoming a structural fear trade. That is the line investors need to watch, because once the market crosses from event fear into structural fear, the pricing can move much further than most people think possible. And that is where gold's signal becomes critical. Gold is often mocked when everything feels stable. People call it boring, old-fashioned, unproductive. But when stress enters the system, gold starts acting like a lie detector for monetary confidence. It asks one brutal question. Do you fully trust the institutions in charge to contain this? If the answer starts drifting from yes toward maybe, gold notices quickly. If the answer drifts from maybe toward no, gold usually notices before the headlines catch up. That is why this move matters more than it looks. Because if gold is rising into a war shock, while oil is adding inflation risk, and silver is turning chaotic instead of collapsing, then the market may be forming a very specific message. The message is that this is not just fear. It is unstable fear mixed with unstable inflation expectations. And that combination is far more explosive than either one by itself. Now let's talk about silver more directly, because this is where people usually get trapped. When silver becomes chaotic, inexperienced traders think the metal has lost its story. In reality, chaos often means the story is too big for the current positioning. Shorts think growth fears will crush it. Bulls think monetary demand will rescue it. Momentum traders chase breakouts. Liquidations hit leverage. Physical buyers step in on dips. All of that creates the kind of action that looks irrational until suddenly it resolves in one direction and leaves half the market behind. And in a war oil-gold setup, silver does not need calm conditions to win. It needs one thing: a reason for the market to stop treating it like an industrial side metal and start treating it like a stressed monetary asset with inflation leverage. If that switch happens, silver can move with a speed that shocks everyone who spent too long waiting for a perfect entry. That is why chaotic price action is dangerous to dismiss. It can be confusion, but it can also be pressure building inside the spring. Now add one more layer. If oil keeps climbing, businesses feel it, consumers feel it, bond markets feel it, central banks feel it. And if central banks start sounding trapped instead of confident, gold gains another tailwind. Then silver gains another indirect tailwind too, because once gold validates the hard asset narrative strongly enough, silver usually stops asking permission. It starts chasing the gap. That is when the market goes from skepticism to urgency. And urgency is where revaluations happen fast. But here is the bigger implication. A lot of investors are still acting like the world is in a clean, post-crisis normalization phase. They still think inflation was the last battle, rate cuts are the next chapter, and risk assets just need time to digest the landing. A war shock paired with oil strength and precious metal stress challenges that whole script. It says the world may not be heading into normality. It may be heading into a new cycle of instability, where inflation, conflict, supply pressure, debt stress, and monetary distrust take turns hitting the system. If that is true, then old assumptions about valuation, safety, and portfolio balance start to break down. And once those assumptions crack, money moves. Not all at once, not cleanly, but meaningfully. First, defensive capital gets more selective. Then speculative capital starts chasing volatility in hard assets. Then mainstream money slowly realizes the move was not temporary. That final phase is when the biggest frustration begins for latecomers, because by then, gold no longer looks cheap, silver no longer looks calm, and the easy opportunity is gone. The market does not ring a bell and announce the transition. It lets confusion hide the transition while it is still early. That is exactly why these moments matter. So what is gold's huge signal here? It is not just that gold moved. It is why gold moved in this mix. Gold is effectively saying that the market is taking the combination of conflict risk, inflation risk, and policy uncertainty seriously enough to seek protection before the full consequences are visible. That signal becomes even louder if gold holds strength despite volatility in stocks, bonds, or the dollar. Because then it is not reacting emotionally, it is repricing trust. And repricing trust is one of the most powerful moves any market can make. Silver chaos fits inside that interpretation. If gold is repricing trust first, silver may still be stuck repricing uncertainty through a more violent lens. But once the market decides which part of silver matters more in this phase, industrial weakness fears or monetary hard asset demand, the chaos can disappear very quickly. Usually not because volatility ends, but because direction starts overpowering hesitation. That is the move many people miss. They see silver whip around and assume there is no thesis. Then the thesis arrives all at once. And there is another reason this story could escalate. War shocks do not only affect supply, they affect psychology. They change business behavior, procurement decisions, hedging behavior, and government messaging. Companies start planning for disruptions. Countries start thinking strategically about reserves and energy access. Traders start paying higher prices to avoid future scarcity, rather than lower prices to maximize today's efficiency. That behavioral shift is inflationary in ways that standard models often underestimate. It is not just the barrel of oil that becomes expensive. It is the uncertainty around the barrel. That uncertainty can bleed everywhere, into freight, into insurance, into manufacturing, into food, into fuel expectations, into consumer confidence, into rate expectations. And once it bleeds everywhere, the market's so-called safe assumptions stop feeling safe. That is exactly why gold's signal may be so important now. Gold tends to respond not just to visible inflation, but to the fear that visible inflation is about to become harder to control. It responds to the possibility that policymakers will be late, that markets will be fragile, and that financial assets priced for stability may be underestimating how unstable the next stretch could become. In other words, gold often starts moving when the official narrative still sounds calmer than the underlying reality. So ask yourself this: what if the silver chaos is not the warning, but the distraction? What if the real warning is that gold is already beginning to price a world where war risk pushes oil higher? Higher oil revives inflation pressure. Revived inflation pressure traps central banks, and trapped central banks undermine confidence across the broader macro system. If that is the chain reaction, then silver's swings are just the messy middle of a larger story. And the larger story is that hard assets may not be done. They may just be getting started. This is where the stakes rise for investors, because if you wait for absolute clarity, you usually pay for it with a worse price. But if you jump at every scary headline, you get chopped to pieces. The real skill is identifying when a market move is noise and when it is a message. Gold's behavior right now looks a lot more like a message than noise. Oil's move adds credibility to that message. Silver's chaos adds tension to that message. And tension in markets often appears right before expansion. Now, none of this means every move goes straight up from here. Markets do not reward good narratives instantly. They punish impatience first. There could be reversals, violent pullbacks, fake-outs, profit-taking, even moments where silver looks completely broken for a day or two. That is normal in a stressed environment. But normal pullbacks inside a bigger repricing story are not the same thing as thesis failure. And that distinction is where winners and losers get separated. Because losers look at volatility and assume the market has no idea what it is doing. Winners ask why volatility is clustering around certain assets at certain moments. Why gold? Why oil? Why silver? Why now? Those questions matter more than any single candle on the chart. And if you answer them honestly, the picture gets clearer. Gold appears to be signaling distrust. Oil appears to be signaling inflation danger. Silver appears to be caught between fear and opportunity, which is exactly where the biggest moves often begin. Put those together, and you get a market that may be transitioning from routine uncertainty into a much more dangerous macro phase. That does not guarantee one exact outcome, but it absolutely changes the probabilities, and probabilities are everything. If the probability of sticky inflation rises, gold benefits. If the probability of policy confusion rises, gold benefits. If the probability of broader hard asset demand rises, silver eventually benefits. If the probability of economic fragility rises, volatility stays elevated. And if all of those probabilities rise together because of one geopolitical trigger, then one war shock can end up doing much more than moving a few commodity charts. It can change how capital thinks about risk itself. That is why this moment is bigger than the average market scare. This is not just about whether silver closes green or red tomorrow. It is not just about whether oil gives back half the spike. It is not just about whether gold pauses for a session. It is about whether the market has started recognizing a new regime earlier than the headlines are willing to admit. A regime where conflict is not isolated, inflation is not finished, energy is not stable, and faith in easy policy solutions is starting to erode again. In that world, metals are not random trades. They become signals, and gold may be the clearest signal of all. So here's the takeaway. War shock hit, oil reacted, silver turned chaotic, but gold may have told you the deepest truth first. The system does not look as stable as it did a week ago. The inflation threat may not be as dead as many hoped, and the market may be quietly shifting from confidence mode back into protection mode. If that shift continues, then what looks like noise today could be remembered as the early warning phase of a much larger move. So the question is not whether this week feels dramatic. The real question is whether gold just warned you that the next phase of the macro story has already begun. And if that is what happened, then the chaos in silver is not the end of the opportunity. It may be the beginning.